Okay, welcome everybody, and thank you so much for joining me. We are live in Dubai, so don't want to talk about it too much, right? I'm sure there's going to be a few questions later on. Everybody kind of knows what we're going through here in the Middle East, but so far, just the basic update, everything, don't want to jinx it, of course, knock wood, but everything seems to be 100% normal, I would say. I've kind of been saying this for a while that I'm in communication with my family and, people back home and as well as social media. And there's just seems to be a tremendously wide gap between what people are hearing is going on versus what I'm literally reporting on the ground. So I guess not surprising. It's the media machine at work. It's social media algorithms. Negativity sells, positivity doesn't. You can't go on there and say something positive. Nobody looks at it. But you say negative stuff, the sky is falling, and the algorithm just goes absolutely crazy and it just shares it with everybody. So it's been a little bit of a struggle getting proper information to people. But anybody who trusts my judgment, family, friends, and whatnot, hopefully the VTS community as well, I can assure you that it is not nearly what has been portrayed on social media. So I'm fine. I'm safe. I'm just uninterrupted schedule. Like I said on Twitter recently that I'm basically a 0 out of 10 fear level, and I'm not trying to act like a tough guy. Like there's literally old ladies walking on the promenade. There's kids playing. Their pools are full, the beaches, the parks and whatnot. So I'm not some kind of tough guy saying, "Oh, I'm not afraid of war." It's literally, the promenade is packed. So we're all good here. Don't worry about us. You can ask your questions later on. I do want to get to the topic at hand. We'll go through that. I think it's pretty interesting, especially now, given what's happening. But we'll get through that, and then, of course, open Q&A. But I am planning to do possibly one more, maybe even two more live streams this week, because I've got a couple of short volatility options trading topics that I want to get to. And the best opportunity to go through those is when we have some volatility. So definitely subscribe to the channel so you're notified of that. And one more thing, if anything I say today is even remotely interesting to you, of course, you can go onto my website, volatilitytradingstrategies.com, click the subscribe tab. There is a free 2-week trial, so you can check out what we do here at VTS and see if it's right for you. You never know. We are mostly focused on risk management, especially at this time of year. So if I say anything here that intrigues you, you know where to do that. But let's get into the first segment. Okay, so the reason that we have to talk about this is one of the biggest pet peeves that I have, being a tactical trader, being somebody who is basically looking at the universe of ETFs out there and designing strategies that utilize them in the best way possible. One of the things that bothers me just repeatedly, and you will know that if you tuned into my live streams over the years, is that there is a massive gap in the financial industry between the marketing material and what they say that the ETF is designed to do versus what actually happens in the real world of live trading. It is quite often extremely disappointing. So we actually have to go through the real numbers. That's why I like to do these things. It's simply not good enough to read the marketing material. You have to look at it on a chart, substitute those ETFs in, and actually see with numbers how it would have performed. So, of course, today we're talking about the strategic tail risk strategy. We're basically finishing off this 3-part series. Couple live streams ago, we went over all the potential ETF replacements for SPY, stable markets, low volatility, and then replacements for let's get a better chart, for the second period. That was the last one that we did. This is about 25% of trading days. This is when volatility is elevated, but not yet at the full panic mode. And then, of course, today we're going to be talking about what we do during extreme volatility. If you want to get an idea for how often these trigger within this strategy, it is roughly aligned with this. It can fluctuate, right? If there's a extended recession, an extended market crash, we would expect to be bouncing around between these two, and we really wouldn't be getting any stock market signals during a market crash, right? Because volatility would at the very least be mid-level. And so If that happened, like it was a great financial crisis, if it lasted 3 or 4 years, you might get a very high percentage of these for a couple of years. But long term, this is stretched over 14, 15 years. This is what we're looking at. So today, we're really only talking about 7% of the highest volatility days, right? That's all we're looking at today. So all the charts you see, none of them will look like the full strategy. It will only look like what it is during those 7% of days. And so the main two purposes that we have here as traders, of course, the number one thing you have to do if you're in a market crash, of course, is you need to reduce drawdowns. That should be the number one focus, right? You have to, at the very least, do this part because, of course, we are expecting drawdowns. It will happen. I understand it's been quite a while. The buy the dip, the propping up the markets, COVID looked like it was scary for a while, but, magically $5 trillion later, there you go, the economy is fixed again. But at some point, we're going to get something really ugly that lasts for several years. Just bank on it. It's going to happen. I don't know if it's this thing. I tend to doubt it, to be perfectly honest, because as grim as this sounds for me to say, war itself isn't necessarily bearish for the stock market. So, take that for what it is. I don't mean to downplay anything. It's awful what's going on, but war itself, not so much of a trigger for a great crisis or anything. It's typically financial. It's typically something underlying the economy. So, take that for what you will. But then, of course, the second part is we need to actually try to profit from it as well, because the vast majority of investors have no idea what to do in a crash. They basically are buy and hold pie chart style investors. They hang on for the ride, and they really don't know how to cycle out into safety. So this is what we do. Now, for our tactical volatility strategy, that would be the green one here. For that strategy, we do go all out long volatility. VXE or VIXM, they're materially identical. And that's when you can make a really, really big profit, right? 1/3 of our portfolio will be targeting long volatility in an extended recession to make the big money. But what we're talking about today is simply the chaos portion. Remember, 7% of trading days. So we're not talking about looking for slam dunks here, but the reason we use chaos, right? This is the ETF ticker, pretty awesome ticker if you ask me, chaos. But essentially what it's designed to do is exactly that, profit from a market crash, but also it's cleverly constructed so that it actually doesn't bleed that much capital during calm periods either. It is expected to go down, of course. Insurance costs money. You can't have something that goes up during a crash and then also goes up other times, right? The same ETF can't achieve both of those things. But chaos, I've gone over it. I've done an extended article explaining it. But essentially, it's protective puts, which can profit from a crash. Box spreads is essentially just a option strategy that, in this case, capitalizes on the risk-free rate of treasuries, basically short-term treasuries, and then again put spreads to boost that and it kind of fill in the gaps there. So you can see, as long as there is a yield to be made, they're basically spending that profit and actually insulating the downside. So like I said, it's only 7% of trading days. So we're not looking for slam dunks here, but this is pretty awesome. You're talking about basically boosting your overall return by, here 35%, basically. And of course, if we get an extended recession, we're looking for better. But this is what we're trying to beat. The question is, can we do better than this? So now let's go through a bunch of these and see if we can figure out something that's at this or better. Obviously, I am open to switching, but I do this for a living. I've scoured the globe. I kind of know what I'm doing, but people like to see these numbers, so here we go. All right, the first one we're going to do is long volatility. There is nothing more synonymous with profit in a market crash than long volatility. That's essentially what it's for. It has no other purpose other than that because it will bleed capital in a stable market, obviously. Like I said, insurance costs money. But you can see that the VXZ, this is the midterm VIX futures ETF, it's actually a better performer. Now, 7% of trading days is an awful lot. The reason why we use VXZ in our tactical volatility is that this is geared only about 2.7% of trading days. So when you reduce it down to 2.7, this really big give back over here is eliminated. because 7% is way too often to be holding long volatility. If you can get it down to 2 or 3%, that's when you can really make big profit during only a crisis, and then you're out of it and you're back into the mid position, in this case gold, most of the time. And that's how you get this. But just showing you that the VXZ, technically speaking, is also a choice there. It's too wild and crazy. So IYR, the reason this is showing is because this is what we use in our mid-level. And a lot of people would ask the simple question, right, before we even get into all the replacements, well, what would happen if we just didn't cycle into safety, right? Why don't we just do a SPY at 70% and an IYR at 30%? Why even bother with this, right? Excellent question. This is why. The vast majority of assets out there, they are correlated to the stock market. And this is one of the things that I just have to warn people over and over again whenever we're talking about these types of things is you will be bombarded with buzzwords in the financial industry, risk management, diversification. You've got all of these different assets in your pie chart, and they're all different. They sound different. This one's emerging markets. This one's real estate. This one's crypto. This one's stocks. What you have to understand is almost all of them are correlated to the stock market. So in a crisis, they all go down, right? So your diversified portfolio ends up just being a whole bunch of asset classes that sound different, but they all go down in the market crash anyway. And you can see IYR real estate, if you're planning to hold it during the extreme market crash periods, when volatility is in the top 7% of readings, yes, you can expect some major pain. And again, this is during COVID when it was a very quick bounce back, but expect it to get even worse. So that answers the question. Obviously, we have to cycle into safety, right? That is a given. What about gold, right? Gold is what we use in the mid-range here. It's worth asking the question, how does it do during an all-out market crash? The answer, okay, unpredictable, right? Because again, this is one of those situations where when the market crashes, oftentimes people just sell what they can sell. They're not maybe making rational decisions like I'm going to sell this one, I'm going to cycle into this one. They're not nimble like we are in the VTS community. People panic and they basically just sell what they can sell. And so oftentimes what you'll notice in a crash is that while gold is a good safety asset and it performs very well over the medium term, in the first few days, maybe the first week of a market crash, it can also be quite unpredictable. So you tend to see that type of pattern. It's still fine. This is not a disaster. And, we do use gold in other places in our portfolio, but of course it's not as good as chaos. XLU, utilities. I've often said utilities is one of the very best safety positions. We use it in our defensive rotation. Again, mid to high level, not extreme, just over here, it's a tremendously good performer. But what happens if you actually use it in the extreme? Well, again, the same thing. No surprise, it's going to be correlated with equities, at least in the first few weeks. And this is really why most people, even though they think they have a diversified portfolio, they're basically just long equities, short vol all the time. And they're happy when markets go up and they're really upset when markets go down. You've got to be careful with assets, even if they're labeled safety. They're not always safety, not during extreme volatility. They're not safety. TLT bonds, 20+ year treasuries. I don't think anybody's going to be terribly surprised here. Treasuries are having quite a rough run in the last few years. It's really not an asset class that's going to provide any protection any longer, in my opinion, and certainly not in a predictable way. So I have it's been 5, let me think, maybe even 6, but certainly 5 years since I've used any bonds in my portfolio. It's just, there's really no point anymore. Interest rates are so unpredictable. The 40-year bull market since 1980 is kind of over. Bonds are a struggle. So unfortunately, the boomer generation benefited greatly, but for us investing now, bonds are kind of a no-go. All right, DBC, commodities, oil, natural gas, silver, gold, aluminum, zinc, copper, corn, wheat, soybeans, sugar, all the commodities. This sounds like something that, hey, the economy still needs these things if the markets crash, right? Maybe we should buy a commodities ETF when volatility is elevated. Well, again, you're going to see this as quite a big theme today, but no, commodities are not going to protect you in a market crash, obviously. Emerging markets. Now, emerging markets is one that I always pause a little bit when I see it and people ask about it, because conceptually, I would actually like the idea of getting some exposure to emerging market funds in some capacity in my portfolio. We are essentially US based. But again, what I said earlier on is it's not good enough to just think about the idea and, oh, that sounds really good. Maybe emerging markets will do great. I have to actually look at the numbers. I have to just be quant based, just emotions out of it, think about it logically, look at the numbers, and is there space to add emerging markets into my portfolio? Well, it would not be in this position, right? It's not the end of the world. And actually, I showed last week that, during that mid-range, it's actually decent. But full-on market crash, yes, you could expect 30, 40, maybe 50% crash. Obviously, global equities are correlated. Not exactly, but highly correlated enough that I'm pretty confident that if the stock market goes down 50%, emerging markets will not be where you want to park your money. So unfortunately, yet again, we are basically a US-based portfolio as of now. BTOL. BTOL gets a ton of attention. I'm not sure why. It's a really bad performer, but I always have to show it just to prove that to people because the market and material makes it sound incredible. It's one of those that people get super excited about it when they dive into it. Unfortunately, in no period across the board does it do well. A lot of people say, no, you're supposed to use it at this time or that time. It's just, you have to understand what it is. BTOL is just bad, right? It's bad across all environments. Let me see if I can go back here a little bit, 5 years. I just don't see any possible use for something like this. If you look at a chart like that, really the only thing that might stand out is, hey, I wonder if it's doing well during a market crash. Is it at least doing that? And no, it is not. That is the answer. Essentially, it is going long, low volatility, low beta stocks, and it's going short, high volatility, high beta stocks, which, if this was back in Warren Buffett's days, that sounds like a pretty good idea. But these days, it's actually the high beta stocks that sometimes are the best performers, and you don't want to be short those ones. So yes, BTOL, I'm not going to tell you stop asking about it because I know people still will, but BTOL is just a structurally poor ETF, at least in this current market. I can't say in the future, but certainly right now. USMV, mini vol factor. They're essentially trying to put together a portfolio of lower volatility stuff. It's fine, but again, expect a massive market crash. If the markets go down, if the S&P goes down, so will this. So will any of the low volatility, all of those things. They're all correlated to each other. XYLD is interesting. This is one of those premium collection strategies. It is essentially a buy right strategy. So you're doing covered calls. It can produce a nice little yield. People actually like that. And they get the idea that this should actually be pretty good. But the thing you have to remember is, imagine what you're doing when you're trading a buy right strategy. You're essentially long the underlying equities, and then you're selling covered calls and you're collecting the premium. That's where you get that yield. It's an income ETF and it's incredible for marketing. People eat these things up. Unfortunately, also think about what happens in a market crash. The underlying that you're holding goes down, so you have no protection against that. And the covered call that you sold is typically for little tiny premiums. So you're selling, let's say, a 1% covered call, and then the stock market goes down 50%. Are you insulated from that? No more than the 1% covered call, right? So instead of going down 50, maybe you go down 49. That's why whenever you plug in these numbers, come on, get my presentation. When you plug them in, they still suffer catastrophic drawdowns in a crisis because, of course, during COVID, the stock market was down 35%. Yeah, the covered calls help a little bit, but certainly not going to protect anything. So buy right strategies kind of suck. MLPX, MLPs, good yield, seems like somewhat of a defensive sounding position. I think before I show this, people are thinking in their head, what is the correlation of MLPs to the S&P 500? I think you can probably guess. We're looking at some pretty big drawdowns. Now, otherwise, I mean, that's a pretty decent period there. But again, I'm trying to have an asset class that every 10 years when there's a massive crash or a recession, that I don't have to suffer this. And that's a guarantee. They're going to go down as well. Now, this one is not really an option for us. This is the flow.as. This is just an individual VTS member who said, hey, check this thing out. It's interesting. This is on the Amsterdam Stock Exchange. And if you remember from last week when I plugged it into this mid-range instead of the IYR here, I plugged it in and I said that although the performance is terrible, obviously, this is interesting. Like, I was curious, why did it perform well in the last 2 years? So I said I'd keep an eye on it and I'd maybe plug it into just the high-end signals and see if that's why it's happening. And interestingly, that is true, right? My suspicion there was actually correct. When you plug it into the high range, yes, higher drawdown, much higher drawdown, so I wouldn't use it. This is meant to be a safety position first and then a profit maker second. So anytime there's a big drawdown, it's kind of a no-go right away. But this isn't terrible. So it's, again, this is not something that you're going to probably put into your portfolio, but this is just for idea generation. And it's a demonstration that actually 99% of ETFs don't do what they say they're going to do, but occasionally you get a little bit surprised. So flow.as, okay, I'll keep an eye on it. Now, there's a whole bunch of ETFs that have been launched recently. And one thing that we have to do, if we start in 2020, you can see there's very few occurrences where we can actually test anything, basically only COVID. And so we have to drag them back at least to the end of 2019. If it doesn't launch before this date, unfortunately, I can't test it. So that's going to come into play when I mention at the very end, something like the tail, things like that. They're very small funds still. They can't qualify. So anything that is really tiny, I also excluded those. But let's look at the SPY over the last 5 years. This demonstrates why you have to exit to safety. If you don't, remember, this is during the highest 7% of volatility in the market. There is virtually no chance that the S&P 500 isn't going to be crashing during this period. You can data mine the entire 100-year history of the stock market, 200 years. You will not find a period where volatility is in the upper percentiles and stocks aren't going crazy in some way. So this is why we exit to safety. I would rather like to avoid a 46% drawdown, right? And negative performance. This would tank the strategy. This is why buy and hold sucks. It goes bull market, S&P 500 can make 15%, 17% annualized. But then when you have a market crash, it drags it right back down to earth, down to 7, 8, 10. That's why. You're losing enormous amounts of profit here. So don't hold stocks during a market crash. SPHD, some people say, well, if you add some dividend yield, they get yield protection and they should go down far less. Well, turns out not so much. It's basically the same performance. Dividends don't matter. When people sell, they sell. They don't typically parse, okay, I'll transfer my money in my portfolio from the S&P 500 to a higher dividend yield. Investors don't behave that way. Noble is interesting because it's basically dividend aristocrats. What that means is that they have raised their dividend every year for a minimum of 25 years, which means basically these are solid companies with good cash flow, very consistent long-term. These ones should at least perform quite well, right? And the truth is it's about 1% better. It's certainly not worth using, but somebody asked me to show Noble, so there you go. The last one, just because this ticker symbol is so awesome, cows. These are the cash cows. These are companies that have maybe abnormally high cash flows within them. Again, during a crisis, a company that's very cash rich, you would think that they do quite well, but actually quite terrible. Again, all correlated to the stock market. We're not interested in this kind of thing. We're exiting to safety for a reason. All right, SHV is basically very short-term treasury bonds. Some people ask, well, instead of cash, let's say you held cash, defensive rotation, we've got about an 8% sliver of cash here. Should you just buy an SHV, an SGov, a box ETF? Well, the truth is, it's happening so rarely. First of all, the trade frequency is low. The yield is low. You still have to pay fees. And it's kind of annoying to be in and out of positions that are only going to make 0.17% AUM or CAGR on your long-term 15-year performance. So basically, yes, technically speaking, you would be better off shifting into cash. And you could make the case that every little bit matters. But for me personally, when I say cash, I literally just go to cash. It's only a third of our portfolio, and it's really annoying to be in and out of an additional ETF. So right now we're in cash. We're not in utilities. We moved into cash, and I am literally in cash. Swan, awesome name. I love these things. this is another example of something that sounds great, right? Listen to the marketing here. And I'm sure if you go on their website, it's just absolutely incredible. But this is to provide capital protection against unpredictable, rare, and highly disruptive events that have come to be referred to as black swans. This is incredible. This basically writes itself, right? Who wouldn't buy this in numbers? You actually have to plot it on a chart and look at it. You can't just read the marketing material because clearly, and I don't want to hack on anybody who manages any of these ETFs, I'm sure they're doing their best and they thought they had a great idea. But unfortunately, they just seem to consistently disappoint, don't they? You think that is exactly what I need when the market crashes. And no, it is certainly not what you need. So unfortunately, DBMF, it's kind of popular one. People often ask about this. Managed futures. This thing is not designed to beat the stock market in good times. This thing is designed to protect capital in bad times, right? That's what they're meant to be doing. I would like to see some actual capital protection here, and there doesn't seem to be a whole lot. IVOL, this one is very interesting to me because it actually wasn't on my radar. Somebody I mentioned last time, Bill Luby on Twitter, he said, hey, you might want to check out the IVOL. So I plugged it into the mid-range one here, and if you remember, that's 24% of trading days. And so I looked at it here, and I thought, that is actually quite interesting, that even though you could make a case that the performance is worse, there are periods here where it's the same, right? I mean, you're kind of splitting hairs at this point. This is actually quite good as well. I would say it's a follow-up second or third place, basically. So I thought, I'll plug it in for the high end as well. So now we're looking at the 7% of trading days. And again, you could certainly make a case that it's number 2, number 3. This IVOL fund is actually worth taking a look at. If you're watching my live stream today and you're just here for idea generation, IVOL is something that you might want to plug into your models just to see if that could provide you some protection in certain areas. I think it probably does. Demonstrably here, and just the concept of it, I expect that to continue. Okay, risk parity funds. Last time somebody asked me what that means. It's essentially, they're all a little bit different and it depends how far you want to go with it. But essentially, if you were to imagine, say, a 60-40 portfolio, right? 60% stocks, 40% bonds, that would typically be allocated because stocks are expected to perform better, right? Bonds are there to be protection. Stocks are there to perform better. Essentially, a risk parity fund just measures, they basically allocate the portfolio based on risk metrics and perceived levels of risk rather than performance. So in the case of a 60-40, minus the last 2 or 3 years, which bonds have been terrible, but presumably bonds have lower volatility, so you might actually have a risk parity fund that has the safety assets higher than the equity assets. But all we care about, again, is just straight to the numbers. Does it work or not? And no, it does not. Spoiler alert. QMNIX, equity market neutral. Interesting. Somebody sent this. They said this must work, right? It's designed to be market neutral. It's uncorrelated to the equities. This should be what we're looking for. And I would agree it's fairly neutral. It's, I would say, maybe better than cash. Would you take a 0.7% return and a 10% drawdown? Maybe. I would say it's probably better than cash. But the problem here is that any option traders out there, that you already know that you have your own risk parity fund, or your own market neutral fund, that iron condors is a market neutral option strategy, but they actually perform better when you initiate the positions during mid to high volatility, right? It widens the wings, you get more protection, you bring in more premium, and they actually perform quite well during mid to high volatility. So you don't actually need an ETF that's packaged. What you actually need is your own iron condor strategy that you can overlay on your portfolio. Not overlay, I shouldn't have used that word. You basically allocate a percentage of your portfolio, whether that's 5 or 10, and you just rinse, repeat iron condors, but you're selecting for certain metrics, right? You're not just doing this and doing it on a calendar schedule. That's not going to work. You have to actually target mid to high volatility. You have to target the right time frame. You have to layer them properly. And there are ways to trade in a very effective iron condor strategy that would blow this out of the water, right? This is just a financial industry style packaged product that's very restrictive. It's not going to have any performance. And I suppose I should just do a super side tangent here. Inside the VTS community, there is actually a 30 video Iron Condor course that is in our course library. It's essentially our course library is available to you on the free trial as well. Like you essentially get access to everything that we do. And there's a bunch of courses here, but the one that I'm talking about is this one, the Iron Condor course. 2 weeks is easily enough time to rip through this. There's 30 videos teaching you everything you need to know about Iron Condor. So just a shameless plug here. If you are interested in building your own market neutral strategy, there you go. You've got 2 weeks to watch all the videos. Go on my website and claim your free trial. All right, WTPI. Again, another interesting one, premium fund. This is basically selling put options. This is what would be considered the classic wheel trade. So I'm sure everybody's kind of used to this. They know what it is. The wheel strategy is not unique to anybody. It's not like I invented this thing. I certainly didn't. It's everywhere. You sell a cash secured put on either a stock or an ETF or an index. And then if you're not assigned, you just collect your easy premium and you go back to step one. If you are assigned, I take it a step further. I call it the wheel of fun for a reason. You go around the wheel, you sell the covered call very, very aggressively, and you try to dump the shares. Now, does that work in a prepackaged financial industry product? Well, obviously not. Because again, if you think about what's happening here, this is very important for people to understand. When you sell a put option on the S&P 500, you are on the hook for the entire downside minus the small premium that you brought in, right? Maybe you brought in 1 or 2% premium because you sold them out of the money put. If stocks crash, guess what happens to your put option? It is basically 1-to-1 delta on the downside and you get wiped out. So the wheel strategy is not some miraculous risk management tool. You have to do it correctly. You need extra risk management. You have to know how to get out of the positions. This can also be used on the call side. You can start by selling an out of the money call. If you get assigned, that would put you short the shares. And what happens when you're short the shares? Well, you can sell covered put options and collect your premium. But if that stock just keeps going up on you, you keep losing money, right? That covered put option is only going to be a 1% premium. You're not reducing your downside. So expect massive drawdowns once in a while. And this is why if you're trading a wheel strategy, there's nothing wrong with it. I do it as well. It's one of my favorites. But of course, you need risk management. So spoiler alert, at some point in the next several months, we will relaunch our VTS Options Academy, and we will have some fun with options. So stay tuned for that. But don't use call right strategies. Don't use put writing. They don't work. The financial industry is far too restricted. They don't select the right tools. They don't have any risk management. Those funds will fail. Okay, ICVT. The only reason I'm putting this here, it's not an option for me. I mean, I already know what it's going to look like. But I just wanted to give a heads up to people. Sometimes, again, a marketing material type thing is they will talk about things in the context of bonds, but not all bonds are created equal. The word bond itself is about as varied as the word sports. Like, I think we can all agree there's a pretty big difference between bowling and kickboxing, right? But they're both sports. Bonds is the same. So if you are associating the word bonds with safety, that is a mistake. Oftentimes it's sold that way, but bonds come in all different forms. So be very careful. There are very many funds that have the word bond in them that are basically going to track equities. So again, you got to actually put the numbers to the page. You can't just read the marketing material. So that is essentially it. S&P 500 was the best choice as we went through that live stream. This is the best combo for the mid-range. We didn't find anything that was better. And hopefully everybody kind of agrees after going through this that there isn't anything better than chaos either. So chaos wins. This is why we use it. It's mostly a non-factor. Like we might move in and out of it many, many times over multiple years and not make any money doing it. But the reason that we do it is there will be at some point, I promise you, there will be a market crash. There'll be a flash crash. There will be a cyber attack. Not to scare you, I'm not that clickbaity type person, but bet on it. And that is when once every 10 years, maybe, on average, recessions happen about once every 6 or 7 years, but this one has been a tremendously long bull market. So let's say 1 in 10. I do want people to be able to actually reduce drawdowns. Number one goal. You cannot stay in equities. You cannot stay in equities. You'll suffer the full drawdown. And B, profit from it. If stocks are going to crash 40 or 50%, you should actually try to take that as an opportunity rather than set you back 15 years of your investing time horizon, which is typically what happens, right? The financial crisis, it didn't reach the inflation-adjusted break-even for 6 years, and it didn't reach a reasonable rate of return for another 5 after that. So it's a lost decade, basically, of investing. If you go back to the dot-com bust, same thing. Took the NASDAQ 17 years, inflation-adjusted, just to break even. So you don't want to do that, for sure. Fair warning, it's been an awful long time since we've seen a market crash of any significant kind. But it's on the horizon. It'll happen. So that's it. Chaos is a great fund. And when markets crash, full-on crash, super high volatility, we are in cash, defensive rotation. We are in long volatility, in tactical rotation. And we are in chaos in the strategic tail risk. That is our portfolio. So let's get into some questions here. I'm going to cut this a little short because, like I said, I do want to come back maybe multiple times this week, maybe 2 more. And so I want to kind of spread these questions out. So if I skip you, it's, no offense, but I'm just trying to plan out that we have 3 Q&As potentially this week. And I want to kind of spread it out. Okay, to be clear, the charts showing relative performance hold cash or an ETF like SGov or Bill when not in use. Cash. Anytime I'm showing, I want to reduce all the variables so that people are looking what they're actually looking at. So it includes dividends, it includes fees, and it is alternatively either in or in cash or some other ETF. There's no like hidden, by the way, I cycled into, box spread or something like that. No, it is cash. So you said that war isn't bearish for the market. There's one exception to that, okay? Namely 1973, the 3-week war, which pushed the market down for a longer time period. It's true. Law of large numbers, war is essentially net zero. It's kind of like government shutdowns, net zero. But of the, God, how many wars are there? How many major wars or conflicts? There are several of them that crashed hard, right? I remember I showed the chart, I think it was last week. There were some of them that were down 20%. I'm not saying that it never happens. Just war itself could just be a trigger for an overstretched market. But the war itself doesn't, surprisingly, is not as bearish as people might think. That was my only point. We could go off a cliff here any second now. Before I answer this one, why don't we just check that out? Like the market's made a fairly miraculous comeback today, back down 0.62%, but it was actually getting close to flat. I think I saw it at one point, it was down 0.14%. So it was down about 1.6 at one point, and then it almost went green. So, and that's to be expected. I will come back to that question I flashed, but expect that, right? The one thing that we can say is when volatility is elevated, all market participants out there are scrambling to try to represent the positions based on just massive uncertainty. So you have to expect whipsaw. When we say something is a safety position, gold, for example, gold is a safety position, just quantifiably speaking. You map it into any strategy, gold does well. But that doesn't mean in the first few days, people aren't going to also dump their gold. They'll probably get their wits about them after a little while, and they'll realize that my money has to go somewhere, and it's certainly not going in the stock market, so it goes into safety assets. But yeah, all bets are off during market crashes when we're sort of teetering but not quite in a trend. What I'm hoping for, essentially, is that we get some clarity. And you've seen my portfolio. I don't really care which end of the clarity it is. If the market recovers, we will shift into stock market short vol. If it falls off a cliff, we will shift into long vol and chaos. I don't care which one happens, but I don't like chop in the middle. Like, who does that, right? It's just whipsaw. It's very annoying. It can happen for a week or two, and it's frustrating. But once the market catches a trend in either direction, that's when our portfolio can kick in and do its job. But expect the unexpected and expect whipsaws and expect, oh, today's up 2%. I'm going to pour into the market. And then 2 hours later, it's down, right? That can happen. So chill out, sit on your hands, wait for clarity. Don't second guess. Just stick to the system. That would be my recommendation. All right. Do you know of any other strategies that iron condors that are built to do well while market goes sideways? Sideways, I have a strategy that I call the volatility trend. You might have seen something on it. There's a YouTube video. You can type in volatility trend. I'm essentially buying slightly out of the money broken wing butterflies on VXX and UVXY. And you can imagine what happens if you lead the market slightly, then if UVXY does its thing and it trends down, that's when you're getting your profit range. But it's a broken wing butterfly, meaning the mid to high end is no loss. So if the market's just chopping around sideways, that's when a strategy like that can actually do quite well. Another one that I do quite often is earnings trades. The reason earnings plays works quite well is because it's technically a long volatility position, right? The way that I do it anyway, buying a long straddle or a calendar, maybe 2 weeks before the earnings play, closing it out right before, things like that. Because then if it's flat, it does its thing, right? Volatility steadily elevates and you can make money during a flat, choppy market. But if the market happens to crash in that time period, you are actually also long volatility and you get that Vega kicker in the end as well. So that would be one. Flat markets are surely the most difficult. Obviously trends are easier, right? Easier to make more money in trends. But I also do a strategy called directional flies. I'll just show you what that would look like really quickly. Just a random example here. SPY, hopefully this loads. Why is my internet so slow? I am using my phone as a tethering. This isn't going to work. Sometimes it just spins forever. Hopefully I'm still here. Am I still here? Can people hear me? Hello. I'll use my hands here to describe. So if you do, say, a butterfly, at the money butterfly on the S&P 500, right? You don't care if it goes up or down. You just want it to be stable in the middle. Obviously, this is something very similar to an iron condor that the market is, if it's choppy, you can expect to be in your tent quite often. But the directional flies part of it is I will just break one of the wings a little bit to the side of the trade that I slightly favor. So it doesn't make it directional. It just makes it like this. And then one of them, you just kind of shift it a little bit. So one of them is a less loss than the other one. So right now you could do a at the money SPY butterfly and then basically break the wing. If you think this is all going to be over in 2 days, you break the wing so it's slightly more beneficial if the market recovers and you lose a little bit more if it doesn't. And then if you think if this is going to last a long time, you don't want to take a full conviction directional hard play, right? You could lose the full trade. So you do the directional fly where you just break the wing a little bit and it just skews it a little. So if the trouble happens for 2-3 weeks, that trade can still make money. So that's also one that it fills in the gap where trend following fails. A lot of my option trading is filling in the gap where trend following fails. I don't need any help when the market's doing well. Obviously, my portfolio is leveraged long at that point, and I don't need any help when the market is crashing and we're in a financial crisis. What I need is something in my portfolio that's also making money when everything is choppy and whipsaw. And that's when options trading comes in. Okay, there is an ETF named TZA. Unfortunately, it doesn't perform well outside crash, but in this time you can martingale. Oh, that word is just like fingernails on a chalkboard. Martingale. Could you check it out? TZA. I certainly can. Martingaling. I did a video recently on that guy that basically led his followers off a cliff. They lost everything. Martingaling iron condors. And it's not necessarily that it was the iron condor that was at fault, right? The martingale strategy itself is always on a long time horizon going to fail. For anybody who doesn't know what it is, just imagine you go to Vegas and you put $100 on red. You're playing roulette. If you lose, then you just put $200 on the next one because, of course, you just hit red. Of course, the next one's got to be black. So you just do that. And then if that one fails, put $400 on the next one. It's fine. If that one fails, well, now it's getting a little uncomfortable, but take a little money out of your wife's purse and put 800 on the next one. Certainly you're not going to lose 4 times in a row. And then the fifth one, you get the point. Eventually, on a long enough time horizon, any number sequence is going to go against you. You are not wealthy enough to martingale. That's the end result is it doesn't matter if you're a billionaire. At some point, statistical probability means that you're going to roll 7 heads in a row. It just happens. So psychologically, it's a cognitive bias where we think if I lost this trade, surely the next one has a higher probability of success. And if I lost 4 in a row, obviously the fifth one's going to be black. But, elementary statistics will tell you that no, the next one is you're putting literally your life savings on a 50-50 trade at that point. And so that was a whole long spiel. I know you didn't mean to, get me going, but that word martingale, it gets me every time. Isn't TZA a 3 times leveraged ETF? If it is, then it can't be used as a safety by very definition. Those things are terrible if you're on the wrong side of the trade. Exactly. That's an excellent answer. They work fantastically well when you call it right. But remember, reduced drawdowns is step 1. The reason I put that number 1 is that is the point of safety. Safety is not for profit making. That's only when you've taken care of the first basket, which is drawdown reduction. So by very definition, 3 times leveraged funds are not safety. I don't care how good it is, how well it performs, and if Jim Simons himself is managing it, it doesn't matter. It's not safety anymore. It is speculative, and you will get the trade wrong at some point, and that's when it crushes you. I was last 6 months on the wrong side, but lost only 12%. I don't know. I'll check it out. I don't really know so not terrible. That doesn't sound terrible. I mean, that's probably down to position sizing. You can make any ETF on the planet safer. You can't make anything safe. There's always risk on the table. You can't make money if there's no risk. But you can make it safer. Can you look at ORR? This is interesting. Somebody asked me about this as well. So I'm not overly familiar with it either. I put out a thread on Twitter basically saying, give me all your favorite safety assets and I'll test them for you. And somebody sent me a data spread, Excel spreadsheet with ORR data going back to like 2015, 2016. And so I tested it. I threw it into my model and it wasn't great. But then somebody else said it's only been trading live for like 8 months. So unfortunately, I think I got burned. I think somebody had the wrong data feed. If it hasn't been trading back until 2020, I can't tell you if it's good because I could read the marketing material and I can tell you already, sight unseen, it sounds great, right? It sounds incredible. I could write anything. This is why buy right strategies are multi-billion-dollar funds, even though they're demonstrably terrible. This is why all of these dynamic funds, the managed futures, all this stuff, the swans, they sound incredible. The DBMFs of the world, you have to see it. You have to see it live trading. And unfortunately, depending on which person sent me the data and who's right and who's wrong, it's possible this has only been trading for a year. So again, I'm always looking to test stuff. So there you go. ARP is another. Keep them coming. I love doing that stuff, dedicate a weekend to just running 100 different ETFs through a model. I love that stuff. So I already tested this one. It's bad, but just rewind a little bit on the rebroadcast. All right. What time is it? There's quite a few questions left, but I wanted to save some of these for next time. Is that your Explorer yacht or an aspirational picture? Are you talking? Can you see my screensaver? I thought my live stream software was set up so you can't see anything on my desktop. I didn't realize you could see my screensaver. This is a Bearing 72 yacht that, yes, this is aspirational. This is about $5 million. I've said, people know that about me, that, I'm into the yacht boating life. My dream is to buy a yacht and just live on it for a couple of years. And that is an Explorer yacht, steel hull. It can go anywhere in the world. It's got a 5,000 nautical mile range. So basically, You could go to Iceland. You could go to, the Arctic Circle. You could go to the Mediterranean and anywhere in the world you want to go. So yes, if money was no object, that's where I'd be sitting right now. I'd be sitting on that Explorer yacht. But no, I am not wealthy. Let's ditch that stuff. Okay, what have we got here? The VXX is flat since August. Historically, did decay insurance premiums rise after long periods of the insurer making no money, so that on average it makes up for the missing short vol returns? So the thing you have to understand is that even though you're technically true, the VXX can go through extended periods where if you look at the performance, you can use words like performance is flat. But the way that it functions, those VIX futures are gone forever. So the VXX isn't flat for a year. It's only flat on a relative scale for the last 30-day constant maturity cycle. It has no bearing on the past. It does not remember the past. So to say that the VXX is flat for a year, when you understand how it functions, is sort of nonsensical. It's like, okay, so it's not a stock, right? There's no market share. There's no cash flows. There's none of that, of course. It's just a constant 30-day rolling maturity of VIX futures that fall off the board and expire every single month. So there is no point plotting anything. I see people drawing lines like their technical analysis on VXX. What are you doing? Those futures are gone. They can never influence the ETF again. Your line should not extend further than 1 week, right? Essentially. And lines are stupid anyway, but that's a side tangent. But yes, so when you say this, no, it has no bearing. The VIX futures are a freely traded market of constantly rolling and constantly new VIX futures. So it just is what it is. If the market is down for an extended period of time, the VXX can be down money for years, right? During the financial crisis, years it was negative. So it has nothing to do with recovering to a previous point or a previous high water mark, or in this case, a low water mark. No, it's just a monthly product. VXX is down for the last month, or up for the last month. That's it. Nothing past that is relevant whatsoever. And there's no insurers managing any of this stuff. It's a methodical ETF that tracks a freely traded VIX futures market. There is nobody managing it. It's just VIX traders. So it is what it is. If VIX traders are continuously bearish the market because the market's going down, that thing can go down for years. There is no catch up, right? Hopefully I explained that. It's a little bit weird concept because, everything in the market is a long-term snapshot of something, right? Volatility products are not that. Those futures are gone forever. So it's gone from, I don't know, VXX probably, 2, 3, 6 million, something like that, down to $50. When you're talking about the UVIX, if you go back far enough, 200 trillion down to zero. Doesn't mean anything. All we care about is what this cycle of the VIX futures is doing. That's it. The next cycle will determine the price direction. So for someone with a small account in this vol market, what about selling call spread on VIX or UVXY for about 3 to 4 week hold? Buying puts, you get vol crushed. So you are correct that when you buy puts when volatility is elevated, VIX over 30, you're paying a lot of money. You're going to get hit with the Vega headwind. And even if you're right directionally, you can end up losing money just because when the market settles down, that is also going to crush you. And so your delta direction could be correct, but your Vega bleed, like you just get that vol crush, you could lose even more on that. So sometimes it sounds crazy, but people will buy put options when the VIX is 40 and it goes back to 10 or 15 or 20, after 3 months, and they lose money. And they're like, what the hell? I don't understand. Well, yeah, because you paid a fortune. So what you're saying about call spreads, now you're dealing with both a long and a short contract. And as long as they're close enough together, you've basically eliminated the Vega headwind, right? If your short contract is a significant number of strikes away from your long, then the short Vega is going to be way stronger than the long. But if you're talking about a small account, you're not going to want to spread that out anyway. So you're talking about probably like one strike gap between them. So there's no Vega headwind. It's a pure directional trade. And yeah, where do you think it's going to go? The only thing is 3 to 4 weeks. I like to just, the thing about options trading is that it has inherent leverage in multiple ways. The first way, of course, is that the capital expenditure is very small upfront, and you can make a ton. Like you control the asset with very little money. So there's leverage there. But there's also a way to add leverage by shortening the time frame. You're essentially churning a whole bunch of trades and you'll make more money. So if you do this trade for 1 week out, yeah, you could make way more money. And you could churn multiple trades in the time frame and add leverage. 3 to 4 weeks, it's less. 2 months, 2.5 months, the potential profit is even less, but it's safer. So for me, whenever there's a market crash, I like to give it some time. I don't like to do 3 weeks because, 3 weeks isn't that long. I mean, sometimes volatility remains sticky for quite a while. So I would just say, especially if you're newer to trading with a smaller account, just do a couple of real smart trades for 2 to 3 months out and just, bank your profits. Get your money. It's not going to be as impressive as if you just go all out short dated, but longer dated options are far safer. Okay. For a young man who's very interested in the financial investment world, what are your recommendations professionally and thoughts on working in that sector knowing a recession crash might come? Well, everybody needs a job. So there's nothing wrong with that as a job. It's a very admirable job, I would say, and it's a very potentially lucrative job. So even though I hack on financial advisors and fund managers, the reason that I hack on them is because their performance is terrible. But oftentimes that's not because they're dumb. It's because the financial industry handcuffs them and restricts them with compliance officers and regulations, and they know they should do something, but they can't because they're restricted in their methodologies and whatnot. So, but it's a very admirable job. I would argue that, look, you're not curing cancer, but helping people grow their financial future and be financially healthy is one of the very most important things in the world. Like that, everything stems from that. You can take care of your family. If somebody has a health emergency, you can help them have that money in retirement. So you can be proud to be working in the financial industry. But for me personally, as a former professional golfer, we don't have long-term contracts. We don't have guarantees. We don't have salaries. You get money if you play well, and you don't get paid, and you don't eat if you don't play well. So for me personally, performance is absolutely everything. For them, not so much. But what I would say to you is, if you're going to do this, I would start by sort of spreading out your skill sets to multiple directions, because you don't know 5 years from now. Like you said, the market might crash. Who knows what that does to your profession? So I would say, if you're going to do this, get in there, get your job, make sure you have the skill set, and be in the financial industry. But you also want to have a podcast. You also want to have a website, write articles regularly. You want to get a fund, track the performance, throw 25 grand in and track your live results. And that way, 5 years from now, you're not just a financial advisor. You're a financial advisor with a podcast and the skills to speak on camera. You have a track record of live trading that might lead to something in the future, starting your own fund, for example. You can write articles. You can generate a social media following. So don't just say, okay, I made it. I'm in the financial industry. I'm a financial advisor. I work at, Edward Jones or something. Like, that's just not nearly good enough. In this day and age, with AI coming and replacing jobs rapidly, you want to be doing 5 different things at once if you want to succeed in the industry. And then be proud that you're helping people. Don't scam them. Don't lie. Don't embellish. Just keep your head down, do hard work, and eventually, the results will come. Money will come. We all need a job. I'm not against the financial industry. I'm just against bad performance within the financial industry. All right, I've been running long, short, so different approach, but shorting individual stocks is much easier to pick winners than longs. That strikes me as, no offense, quantifiably incorrect, because stocks go up most of the time. So you either have a tremendous skill of picking bad stocks, or you didn't stretch your time frame out long enough, because shorting the market, shorting stocks is a very tough way to make money. I mean, pull up a chart. It's not so easy to make money shorting things that don't go down very often. It's like the same thing that I would say if somebody says, I'm a profitable long volatility trader. I buy the VXX and the UVXY at strategic times and I make money. And then I'll pull up a chart of the VXX or the UVXY and it looks like this, minus a few periods of, spikes, and say, you're either only doing a very short period of time and you haven't learned your lesson yet, or you're wrong. No, shorting the market's a very, very tough game. This is why I have such a large band of safety. The market has to absolutely fall off a cliff for long volatility, chaos, shorting the market, outright short. The SH ETF, for example, is just an inverse of the stock market. Good luck making money trading on the long side with SH. I mean, so be careful. Stretch it out over a longer period of time. Aren't you afraid of going outside and some drone hitting you? I understand that this is, like, emotionally speaking, we're talking about missiles and drones, like last count, something like 1,800 of them. And tragically, we lost 4 people in the Middle East, or in the UAE alone. 4 people died. It's just horrendous, right? Iran hit the UAE harder than anybody ever thought they would. It's just crazy. But I don't know if now's the time to go on a statistical rant about how safe I am here, because people are thinking, there's missiles flying. But why are people scared of sharks? Why are people scared of lions and tigers? Why does a black mamba scare people? If you're talking about the most dangerous animals in the world, it's mosquitoes by a million miles. But mosquitoes are not emotionally scary, so nobody cares. Sharks are scary, right? Missiles are terrifying. It's a missile. If that thing hits me, I'm a goner, right? Missiles are scary. I'm not trying to downplay the fact that 1,800 missiles have been shot at us. But just to give you some statistics, and this is going to sound grim, this is not a great way to speak during a crisis. So give me a little bit of leeway I'm not a cold, callous person. But for example, roughly 1.3 mass shootings in the United States every day. Roughly 3,000 people murdered. And that doesn't include inner city. Like, if you include inner city stuff, it's like 16,000. But just random acts of violence, 3,000 people. Even if you adjust for population, it is safer to be sitting here in Dubai getting 1,800 missiles shot at us than it is to just be on a regular Tuesday in... Oh, wait a second.